Good morning, everyone. Welcome to Phillip Securities Research Morning Call for 14th of October 2024. For stock counter updates, today we have a recap of our US SSP, which was held last week, and also JPMorgan results and Phillip on the ground on Fortress Minerals. We have a couple of technical analysis updates, and for macro, we have Singapore Banking Monthly, and as usual, we would end the session with Singapore Weekly. This is just a gentle disclaimer that the webinar is just for educational purposes and would now like to pass it on to Glenn.
Yep. Thanks, Amrish. Yep. So we just start off with JPMorgan. They released their third quarter results last week. So we'll just start off with their results. The third quarter earnings were slightly above our estimates at $12.9 billion US. The 9-month 24 earnings came in at 81% of our forecast. So the main key highlights were that they recorded higher net interest income, asset management, as well as investment banking income, which were offset slightly by higher expenses as well as provisions. For their dividends, the DPS was raised 19% year-on-year to $1.25, while the dividend payout ratio was slightly higher as well at 28% compared to 24% a year ago, while the third quarter 24 common stock net repurchases surged to $6 billion US compared to $2 billion a year ago. Now jumping straight to the positives, first positive being that their investment banking revenue was up 30% year-on-year, and this was mainly due to higher fees across all products. Interestingly, they also remained at number 1 ranking for global investment banking fees, with their wallet share improving to 9.1% year to date, compared to 8.6% a year ago. Well, the second positive is that their net interest income also rose despite lower net yield. And this is mainly due to the impact of the balance sheet mix as well as securities reinvestment and higher revolving balances in their card services and higher wholesale deposit balances. Their loans growth was low single digit at 2% and mainly came from the credit card as well as the wholesale segments. For the third positive is that their asset management fees were also higher, mainly due to strong net inflows as well as investment valuation gains compared to losses in the previous year and higher brokerage activity. For their AUM and client assets, it has both grown by 23% year-on-year to 3.9 trillion for the AUM and 5.7 trillion for the client assets. And this was mainly due to higher market levels and continued net inflows. Now, for the negatives, first negative is that their provisions surged 125% year-on-year. And this was mainly due to the card services charge-offs increasing by 39%. So their total net charge-off rate has risen by 18 basis points year-on-year to 0.65%. And this is again due to the credit card net charge-off rate increased to 3.23% compared to 2.49%. As for the expenses, it was up 13%, and this was mainly due to higher compensation and employee growth, and this contributed to the non-interest expense rising. Now, for the outlook, JPM EPS has grown at around 6.8% CAGR over the past 2 years, and they have outperforming their peers like Bank of America, Wells Fargo, Citigroup, and Goldman Sachs. And so we believe that this reflects their strong financial health as well as effective management. As for their continued share repurchase, they have increased their share repurchase. Now currently at 9-month 24, we are seeing 12.9 billion of common stock compared to the previous year. For full year FY23, it was 9.9 billion. So this is surpassing their previous guidance of around $2 billion US per quarter of common stock repurchase. They have not given any new guidance on their common stock repurchase or program, but if assuming that their repurchase program is maintained in the current pace, we could see their FY24 EPS rising by around 4% year-on-year. As for their guidance, they have increased their FY24 net interest income guidance from 91 billion to 92.5 billion, of which they expect the net interest income, excluding markets, to be around 91.5 billion. So they do see the net interest income to face some headwinds due to deposit balance pressures. And markets net interest income will be the primary growth driver from balance sheet growth as well as a mix shift in their markets business. As for the expenses wise, it's relatively the same at 91.5 billion, which is reflecting the increase to the FDIC special assessment as well as the foundation contribution they did in the second quarter of the year. As for the card services net charge-off rate is maintained at around 3.4%. So currently for 9 months 24 is around 3.35%. So we should see that being relatively stable going into the rest of the year. We do maintain and accumulate, but with a higher target price of $238 as we raise our FY24 estimates from increasing the net interest income as well as investment banking fees estimates. As we do like JPM for their ability to continue growing revenue in all the segments, and particularly in their consumer and community banking, as well as the corporate investment banking segments. Despite headwinds faced to their net interest income from deposit balances as well as potentially higher provisions from card services, JPM's strong growth in management fees as well as continued net inflows will support their earnings momentum. So that's all I have for JP Morgan. Now we move on to the banking monthly. So banking monthly, firstly, we look at the interest rates. They are, as expected, the interest rates has declined mainly due to the Fed rates cut of around 50 basis points. So Singapore interest rates, similarly, they were down, but not as much. They were down 7 basis points in September to 3.53%. But this is still the lowest that we have seen it since March 2023. And furthermore, the year-on-year, it fell by 17 basis points and was also 6 basis points lower than the third quarter average. And this is the largest year-on-year decline that we have seen since May 2021. So we do expect the 3-month SORA to decline in tandem with the Fed rates as rate cuts start to come into effect and more rate cuts come in as we move along into the rest of the year as well as into next year. As for the Hong Kong interest rates, it was also down. It fell 24 basis points month-on-month, a continuation of the previous decline of 38 basis points. So currently it's at 4.07%. Now moving on to the next slide, the loans growth. Yep, so in a more positive note, the loans growth has continued to be strong and high. So currently, Singapore loans growth is at a low single digit. It's at 1.8% year-on-year, a continuation from the 1.9% increase in the previous month. We still expect low single digit growth for 2024 as loan growth is expected to recover further from the expected rate cuts going into the second half of the year. And the banks are also have maintained their guidance for low single-digit loans growth in 2024. But we could see an update to this guidance once we hear what they have to say about the third quarter results, which will be, I think, coming in the next month, so the start of November. So for business loans, it was up 1.2%, and for consumer loans, it was also up around 2.6%. As for the total deposits and balances, it grew by 3.4% year-on-year, and the CASA proportion was averaging around 18.3%. So this has not changed for quite a number of months, I think about a year, around this 18% range. Now moving on to the next slide. Yep, so another positive would be the SGX monthly statistics, and maybe one of the reasons why SGX has also, the share price performance has been very good for the last month or so. And this is the main reason is that both their securities daily average volume, or SDAV, and the derivatives daily average volume, or DDAV, has both improved quite well. SDAV was up 67% year-on-year and has reached a new high for 2024, while DDAV was up 35% year-on-year and 17% month-on-month. So securities trading saw a substantial increase, mainly due to the easing monetary policies as well as China's stimulus measures, which boosted investor confidence and led to portfolio adjustments. And this is the 10th consecutive year-on-year increase for the DDAV, starting since December of 2023. So essentially for the whole year, DDAV has actually been on this upward good year-on-year growth. While for the VIX, which is the market index that we use to measure the implied volatility of the S&P 500, averaged 17.7, so this is down from 19.3 in the previous month. And this decline was also expected, mainly due to the high volatility in August. So now we're moving to September, hence there was a bit of a drop-off. As for the top 4 equity index futures turnover, it rose by 41% year-on-year to 14 million contracts, mainly led by the higher trading volumes of the FTSE China A50 index futures. Now moving to the next slide, we're looking at the Singapore Bank's performance. So another sort of a positive would be that the three local banks' share price performance was up around 4% in total for September. And DBS was the strongest with an increase of 5%, while OCBC and UOB rose by 4% and 3% respectively. This increase was mainly due to the recovery from the decline in August when there was a sell-off from the carry trade impact. So they just recovered even stronger going into September. DBS has still remained the strongest performer year to date with an increase of 25% compared to OCBC and UOB at 16% and 13% respectively. Now, the next slide. Yeah, so for next slide is just we just do a like a highlight of the month. So this month we'll be looking at the AUM growth as well as the margin, the fee income margins recovery that we would think that will drive the fee income growth and also the bank's earnings. So just to explain this chart I have here on the left, basically the blue bar is the AUM, the assets under management, while the orange line is not fee income, it's fee income margin. So how much they earn from the AUM. So if you look at this, it has been it hit a very extreme high during the end of 2020, and this was mainly due, to the interest rates being rather low. But once interest rates hikes kicked in, you can see that the margin dipped drastically, and this is mainly due to the reason that the customers had shifted a lot of their investments, right, from let's say investment products, wealth management products, which gain a higher margin, into lower margin products such as fixed deposits. Because interest rates are so high, they could easily get 3 to 4% or upwards by just putting it into a fixed deposit, and there's a guarantee. Hence, the margins for the bank's AUM were much lower. But what we have seen recently is that due to the rates coming down, the customers are also shifting their funds from fixed deposits out into investment products, wealth management products, hence higher margin products. So we see this recovery in not just the fee income, which is the highlight, which is the highlight that all the banks like to say that they have double-digit fee income. But what we are seeing is that we are seeing an improvement in the margin as well. And we believe that there's still a lot of room to grow for the bank's margins to improve. And together with the AUM growth, which will continue to drive the fee income as well as drive the bank's earnings, as net interest income is expected to be quite flat going into the rest of the year as well as into next year. So we do expect, a 14% year-on-year increase for fee income growth for the banks, which will add around 340 million to revenue. And there's also much more potential for further margin improvement as interest rates decline. So now the next slide, for my last slide, if you notice at the top here, we have downgraded the banks to a neutral. And although the bank's performance was all up in September, this is really due to the recovery that they had from the previous month. And we are neutral on the banks, as we do expect the NIMs will continue to dip, and it will dip slightly going into the second half of the year and as well into FY25 from the expected rate cuts. But net interest income will remain quite stable from the movement of deposits into longer tenures as well as higher interest yielding assets. But we do feel that the recovery in loans growth as well as continued double-digit fee income growth will offset this net interest income stagnation. Bank dividend yields are also still quite attractive at around 5.7%, so not as high as we have seen it previously at the 6+%, but with upside surprises due to excess capital ratios and a push towards higher ROEs. So that's all I have for the banking sector. I'll now hand it over to John for the US SSP. Thank you.
Yeah, thanks, Glenn. And good morning, everyone. So I'll just briefly run through our US SSP that we had last Wednesday. We'll just go through the market performance for the third quarter. Gold was the biggest outperformer, far exceeding the gains from the S&P and the NASDAQ. It was up 13%, which is very historically unusual. Obviously, you have a few factors for this: interest rates cuts, as well as continued buying of gold by the central banks. Separately, Mag 7 amongst the equities, Mag 7 was actually the biggest laggard for the first time since it was, I guess since the Mag 7 term was coined, which would have been 2.5, 3 years already. Was up only slightly, 2%, whereas the overall S&P 500 was up 6%. Next slide, please. In terms of currency, the dollar actually weakened versus all major currencies. This was mainly due to interest rate cuts. The biggest shift here was in the yen, because the yen started to raise rates while the US cut interest rates. You can see this big swing, almost 13% gain for the yen versus the US dollar. For Sing dollar, we were up about almost 6%. And that takes our year to date, or rather 9 months of this year performance to plus 3%. Next slide, please. In terms of the individual sectors, we saw this kind of rotation out of growth stocks into interest rate sensitive sectors and some of the cyclicals. So you can see here your utilities as well as your real estate, up 19 and 20 and 16%. Utilities is actually the largest gainer for the year. I think they're up almost close to 30%, which is extremely unusual, very significant. The biggest reasons for this was, the expected rate cuts, making utilities a little bit more attractive because of their dividend yield. At the same time, growth for the utility sector as a whole expected to be in the mid-teens year on year. So running off the bottom, you've got all your growth stocks, your technology, semiconductors, and communications. But these are semiconductors are still the biggest gainers for the year. Next slide, please. Yeah, so moving into our investment themes, we have three. The first one will be AI play. It's tough to think about tech without thinking about AI. When we look at AI, we think NVIDIA will still be the main beneficiary, at least in the near term. And how we derive this is that we first of all just follow the money, right? Follow who is spending and what they're spending on. So this chart just shows the capex spend for the last 12 months for big tech companies. So this is mainly your hyperscalers, Amazon, Google, as well as Microsoft. We threw in Meta as well because contributing quite significantly in terms of capex spending. And what these guys are spending on is basically AI infrastructure. When we look at AI infrastructure as a whole, in terms of data centers and all the equipment that goes into it, about 50% of all spending goes to NVIDIA, mainly because they're GPUs. Just one GPU costs like $30,000 US. So at least the Hopper costs 25 to 30,000, and the newer Blackwell will be somewhere in the range of 35 to 40,000 US. Yeah, so that basically one company takes about 50% of all the spending, and then another like 15 to 20 companies take the remaining 50%. So you can see quite a big disparity there. When you look at this chart, you clearly see capex spending continue to increase year on year over the last few quarters. So growth is continuing to increase, and at the same time, absolute dollar is also going increasing. So when we look forward to 2025, we expect close to 250 to 300 billion, at least from these four guys, based on commentary, recent commentary that they say over their earnings calls that how much they expect to be spending. So you just borrow the ballpark 250,000, 300,000, take 50% of that goes to NVIDIA, or at least a substantial amount of that goes to NVIDIA. Next slide, please. So for NVIDIA, we think the growth story remains unchanged. Like I said, revenue growth, even though it's coming down, it's still at 100%. So they're essentially doubling year on year. For next year, it probably won't be 100%, probably close to like 80, 70%, but still extremely fast growth. And you'll see this in this chart, right? Last 6 quarters, you see 6 or 7 quarters, such exponential increase in revenue. And we expect this to continue moving forward, especially as they scale on the supply side. They've always mentioned that demand remains extremely robust. And commentary from both NVIDIA as well as the biggest foundries, TSMC, is also mentioning that there's way too much demand for them right now. They don't expect to reach this demand-supply equilibrium until at least late 2025. So that's for the revenue side. Then on the margin side, we do see some upside because, like I said, the newer Blackwell platform that is basically sold out for next year. It costs 30% more, but they don't obviously. They charge customers 30% more, but it doesn't actually cost them 30% more to manufacture. So we could see a little bit more margin upside here as they start to shift demand from their older Hopper generation to their newer Blackwell platform. The last point I want to make for NVIDIA is that at the time when we did the slides, they were trading about 30 times for PE, which is extremely low given that is in line with the S&P, the Nasdaq, slightly higher than S&P, but when you look at their growth rate for the next couple of years, probably like 100% growth rate on the bottom line for next year, and then another 60-ish% for the year after. We think 30 times is very attractive, and it is also well below its longer term average, about 45 times. So you got those are the three reasons why we still really like NVIDIA. We have a buy rating for a target price of $155. Next slide, please. So my next investment theme will be digital ads. The title is favorable pricing. But one thing we tried to find out was whether there's any trend to digital advertising companies and whether you could, I guess, try to almost I wouldn't say predict, but educate. We have a good educated guess on where stock prices will be going. Something that we found quite interesting was over the last 5 years, they have quite a positive correlation to the consumer sentiment index. So the consumer sentiment index is just a survey that is done in the US for where they basically ask consumers how confident they are on earnings capabilities, whether they have enough income coming in and whether or at least enough income to cover their expenses. And so what we found is that when you look at this chart, as consumer index is in blue, as this kind of rises, you see the stock performance of Google specifically rise as well, and then when it falls, like from the period of 2021 to mid of 2022, it's coming down. There is a bit of a lag, like 3 to 6 month lag. Essentially, you started to see the price come down as well, and then since then, consumer sentiment has been trending upwards, and Google stock price has continued to climb as well. So it's not exactly perfect, but it gives people a rough idea of maybe potentially where stock price could be moving. One of the reasons we think that this happens is because of the nature of what the index tells us. It tells us that consumers are more willing to spend, and that's leading to advertisers. They see this huge opportunity because more people are willing to spend. They see this opportunity to capture a lot of this spending. And the more people are willing to spend, the more advertisers will spend on advertising to basically to try and reach out to consumers to buy whatever products that they are trying to advertise for. So when advertisers start to loosen their belts and spend more on advertising, where this flows to, it just goes to be a big advertisers, maybe Alphabet or maybe Google or Meta. Google has roughly 50 to 60% market share, while Meta has about 30%. Yeah, so that's kind of the theory that we have for this positive correlation. Next slide, please. Yeah, at the same time, election years tend to bode well for digital advertising, mainly because there's quite a significant amount of increase in political spending. We don't really see it here in Singapore, but in the US, it's everywhere. It's not just on digital platforms, but it's also on TVs, on cable, and so on. So basically, the whole advertising industry gets a little bit of a boost during election years. You see this in the stock price in the last two elections in 2016 as well as 2020, significant gains for both Meta as well as Google. Next slide, please. Yeah, so then when it comes to pricing, we're also seeing digital ad pricing improve. Just in case you didn't know, the way that ad pricing works is basically just demand and supply. So they've got a X amount of inventory on hand for advertising inventory from your digital advertising platforms like Meta and Google. And then if there's more demand for X amount of inventory, then prices just go up because it's just a typical economic model. And so what we've been seeing is that digital prices have been improving since the end of, or at least digital ad price growth has been improving since the bottom of 2022. But we expect this to continue moving forward because of some stabilization in a lot of developing markets, which historically has been at lower monetization levels, but have since, I guess these markets have since matured a little bit and provided a bit more stable pricing. Next slide, please. So when we look at advertising, obviously Alphabet is our top pick because they're the king of ads. Top line continues to grow and trend very well. At the same time, margins continue to expand quite significantly. They're almost back to pandemic peak levels of when you talk about operating margin, about 31, 32%. And there are several reasons for this. Firstly, they took drastic measures when it came to headcount cuts. So that saved a lot of their fixed costs. At the same time, they're leveraging a lot of AI technology for both operational efficiencies as well as product efficiencies. On an operational front, is less, I guess, AI. It's more machine learning and RPA that's helping to do a lot of your database management and data parsing and all that. So it's making more mundane tasks a little bit more efficient. Then on a generative AI side, it's making their products a lot more attractive to a lot more users, making it more user friendly, having more features on there for advertising to increase advertising performance. And that's also a big reason why that is driving up prices, because advertisers are finding that these that performance is getting better. B, it's easier to use. It's easier to create ads and to scale their ads. So they're more willing to pay for better performance on platforms like Alphabet and Meta as well. And lastly, on a valuation front, similar to NVIDIA, they're trading at about 17 times for PE, which is traditionally lower than what they've usually been at. I mean, you just think about the comparisons right now. That's trading below S&P 500 and trading well below the Nasdaq. We think, and so that kind of presents a kind of a good buying opportunity that we think. One of the biggest reasons for this is because of the DOJ antitrust ruling that's been hanging over their heads. There's a big worry and uncertainty of what will happen, whether the company will be broken up into pieces, and how will that affect its business model. We think that it will largely be unaffected, even if they are broken up, just because they have such large scale at the moment, especially on their digital advertising side. They have so many users, and they can essentially run as a separate business, no problem. And secondly, we think that first it will take a while for the DOJ to come down with the thing, and even then, even if worse comes to worse and they decide to break up the company, Google will just have its team of lawyers just try to delay the ruling as long as possible, which you could take. They'll just appeal it and appeal it and appeal it. It'll take maybe another 3 to 5 years for anything to really get done. And so that's why in the near term we still think there is quite a bit of upside. The significant increase in uncertainty and drop in share price is just another buying opportunity for the company. So we have a rating of we have a buy rating on Alphabet with a target price of $205 US. Yeah, so that's all for me. I'll hand it back to Ambrish to carry on with the last investment thesis. Thank you.
Thank you, John. So our last investment thesis would be consumer technology stocks. We believe that they may benefit from Fed rate cuts. And as a result, our stock pick for the fourth quarter is PayPal. So PayPal, it's basically a fintech digital payments company, and it has a presence across the globe in over 200 countries, and it has a large customer base of about 400 consumers and about 400 million consumers and about 30 million of merchants. So it tends to benefit from its two-sided network effects as it serves both consumers and merchants. So it basically earns its revenues by charging a fees to consumers or merchants based on the payment volumes that have been transacted on its platforms. And in the chart, it basically shows the payment volumes growth rate over the last from the 5 years or so. So it basically, if we look at the 2022 drop, so we believe that it significantly dropped mainly because of rising inflation, and also the e-commerce it peaked after the pandemic, and then the online shopping experience it tend to drop, and as a result the payment volumes it declined in 2022, but it accelerated in the second half of 2023 and remained resilient this year. So as the Fed rate, they have now started to cut the rates. We believe that going forward in the fourth quarter and 2025, PayPal it could witness higher payment volumes on its platform, mainly because the interest rate cuts it would lead to increased consumer spending on its platforms, and as a result it could generate higher transaction revenues. And secondly, its number of active users it's remained flat on a year-over-year basis, but it's witnessing high engagement within its existing customers. So in the second quarter, its a number of payment transactions per active user, they grew by about 11% on a year-over-year basis. And we believe that this is mainly because of continuous product enhancements it recently integrated passkeys into its platform, and also it introduced a feature like fast lane, wherein it basically enhances the guest checkout process by just one click. And as a result, we believe that going forward with new additions of features, it would continue to witness a high engagement within its users. And also it's focusing on profitability right now. Earlier this year, it announced a job layoff of about 9% of its total workforce. And as a result of continued focus on profitability due to a focus on high operating leverage, we believe that for the full year of 2024, it will continue to witness expansion in its operating margins by about 100 basis point on a year-over-year basis to about 18%. And lastly, also PayPal stock, we believe that it's currently trading at attractive levels, and it's like about trading at a 1 year forward P multiple of 17 times, which is quite low as compared to S&P 500 and Nasdaq's about 30 times. So overall, we have a buy recommendation on PayPal and a target price of $80. And as a side note, the current market price, it's currently trading at about near to our target price. And this is mainly because our this recommendation was issued in August after the company had announced its second quarter results. And we usually update our estimates and recommendations when once the company releases its quarterly results. So we will update our target price on PayPal once the company would release its third quarter results end of this month. So that's all for me. Would now like to pass it on to Zain.
Thanks, Ambrish. Good morning, everyone. I'll move on to the technicals. Next slide, please. So first up, looking at the comparison of this year as compared to our average election year. This year we have seen an outperformance. The blue line in the chart actually represents the average election year returns. Typically by this time, the S&P will usually be up 5 to 6%, and then full year returns will be around 8%. However, this year we have already seen a 20% gain for the S&P 500. So yeah, this year we are seeing a very strong election year performance. Next slide. And next one, this chart actually shows the monthly seasonality pattern for the S&P 500 during election years. And then the orange bar are the monthly returns this year, while the blue bars are the average returns in a typical election year. And then the line in green is the percentage of the time where each month is in the green. So for the fourth quarter, the last quarter of this year, we're expecting a seasonally strong, we can expect a seasonally strong fourth quarter. Typically in October, the market could be down slightly by 0.3% on average. In November, it's usually up 1.1%, and in December, it's up about 1.5%. And then the probability of a December being the green is actually quite high as well. Usually around 80% in the election year. Yeah. Next slide. Next slide, please. Yeah, so for outlook for the Nasdaq for the fourth quarter, we see that it's still overall in the big picture, it's still currently consolidating within an ascending broadening wedge. So price is still generally heading upwards. Price is just kind of sideways at the 18,000 level recently. However, we think that it should continue the upwards momentum from this year to reach about 18,500 to 19,500 area to reach to end of the fourth quarter strongly. Next slide. As for S&P 500 outlook, it remains bullish as well. Price recently just continued to make a new high recently after breaking above 5,670 resistance level. So we see that price could continue this upward trend to actually retest the main trendline resistance in blue to reach about 5,900 to 6,000 area in the fourth quarter. Next slide. Next. Yeah, so for this S&P 500 on a daily time frame basis, so looking at last week's performance, it continued to post a new record high closing after a breakout of a recent range consolidation between 5,675 to 5,765 area. So with that, we are likely to see new highs going ahead. The range projected target level brings the next resistance level to be likely at around 5,850 area to about 5,950 area next. While the immediate support is at 5,750 to 5,800 area. Next slide. Next one, we have a tanker buy for Food Empire at $1.03. Take profit levels at 110 and 115 respectively, with a stop loss at 99 cents. Last close was $1.03 on Friday. So looking at this chart, it looks to be a bullish reversal ongoing. Price has actually broken out of a range consolidation between 96 cents to $1.01 recently after price has actually drifted down since March of this year. This came after downwards resistance line breakout as well. So with the increasing momentum at MACD, we see that price will continue this rebound upwards to hit $1.10, $1.15, the previous resistance levels. Next slide. And next one, we have a technical buy for Samudera Shipping at 83 cents. Take profit levels 92 cents and 98 cents respectively. Stop loss at 81.5 cents. Last close was 84.5 cents on Friday. So looking at Samudera's chart, recently there was a breakout of a range consolidation between 79 cents to 83.5 cents area. And then price did a retest and found support at prior resistance. Coupled with the increasing momentum at MACD, we see that price could actually rebound higher to actually retest the recent resistance at 92 cents and potentially head towards 98 cents to actually fill a price gap previously in end of July. And so next slide. Yeah, this is a summary of the trades initiated. Currently, Food Empire is flat. As for Samudera Shipping, it's up about 1.8% currently. So that's all from me. I'll hand over time to Paul to talk about the Singapore weekly. Thanks.
Yeah, thanks, Zane. Yeah, sorry, there's a bit of background noise here. So just to give you some key macro numbers that came out for Singapore. Firstly, we have arrivals or tourist arrivals. It continues to be strong. It grew about 12% year on year. Just as a comparison, the pre-pandemic, the growth rate for arrivals was around 5%. So we are still growing double the pre-pandemic pace, supported by Chinese arrivals that's growing about 60%. So this would be good for still good for the tourism sector. Ready-mix concrete, which is Pan United and also Hong Leong Asia, the growth is still strong, about 10% growth in demand, volume demand. So July to August, you're looking at around should be around 10% growth, or shouldn't be 11 since it's 10 and both also 10. So around 10% growth year on year. So the volume is still continues to be healthy. For Changi, I guess we monitor this because of sets. So number of flights is still growing, 14. Air cargo is still 9. So it's still generally healthy, although air cargo a bit slower. So for this SBS real traffic is more for comfort that will grow. So the volumes are still there, 2%, still in line. I mean, it's still growing low single digit. For exports, the pace seems to be slowing down. So we do see some slowdown in exports as we approach September, both in Taiwan and Korea. For the US CPI, it was slightly above expectations. I think market was expecting 3.2, it came out 3.3 for the core CPI. The problem is it's the highest in 4 months and it's pulled up by services. But just to give you a flavor, what type of things is pulling up inflation in the US is things like motor insurance, rents, of course, and then motor vehicle maintenance. So services is the one that's still holding up very strongly. For the main CPI, it continues to slide down very sharply, lowest in almost 4 years, but that's because fuel is down 7 and then goods is down 1. But again, services and shelters are the ones pulling up inflation in the US. Next slide. To give you our tactical views, so one thing that's happening is that the 10-year bond yields continue to rise. Despite the Fed cutting rates by 50 basis points, interest rates actually rose. And it's actually at a 2-month high. This is not an anomaly. I mean, it does happen once in a while, but directionally, of course, interest rates will come down. But the worry the market might have is usually when the bond yields are climbing so much higher, is also worries of inflation. And then, of course, maybe worries that the deficit spending by the 2 presidential candidates will accelerate the deficit even more. I think I'll have a chart later. But what we are going through is remove the C here, typo here. So what we are undergoing is a reflationary impulse. So the reflation impulse, what we're saying is that there's a short-term inflation wave now because all prices are rising. Of course, you have the weak US dollar, but also strong inflation in the US, and of course, we have also strong Chinese renminbi, and that will also cause higher import inflation into the US. And you also have a stimulus from China. So all this inflationary impulse is going to be negative for REITs because it will just cause a lot of uncertainty of how many more rate cuts the Fed will do. We'll have a chart later. But one sector that we see the fundamentals improving is the palm oil sector. So prices are, it depends how you measure. It can be ringgit because ringgit jump up by 10%. But if you measure on the ringgit terms, palm oil prices are up 6 months high. In the US dollar terms, it's almost a 20-month high. The other positive for palm oil is mainly for the Indonesian refineries, not so much for the Malaysian, but because they reduce the export levy. So in Indonesia, they have export duty and export levy. The levy here is to fund the biodiesel that they are rolling out in Indonesia. But this will reduce the levy and indirectly kind of go straight to the bottom line. So you're talking about maybe $20-25 per metric ton kind of benefit. The other benefit more unique for Wilmar is, as you know, Wilmar's other business is soybean crush, where they import soybean from the US, they crush the meal, and then they will to supply to all the hog farmers. So that we show a chart later that the margins are recovering from negative 500 RMB per metric ton to now positive 50. So that's because of higher hog prices and lower soybean. Another company we think that will benefit also, although indirectly, is Alltech. I think what they do see is that expansion in Latin America, mainly Colombia. So Colombia is the 4th largest palm oil producer, but it's still small. It's only 2%, but it's growing about 5-6%. So that will benefit because when the production grows, they will need more refineries. They need more fractionalization. Some of the key events happening, these names you see here like Waller, Daily, these are FOMC members. I think right now, they will be watching what they see, whether there'll be another rate cut coming in November. The key ones in green, like ECB is expected or most likely or 99% they're going to cut rates again for ECB, European Central Bank. Then we have Netflix results, TSMC, all this for your reference. Of course, this morning, Singapore released their GDP about 4.1% growth. These are some of the events coming up. Propnex and Centurion and a lot of the REITs are two of the US REITs were representing Core and also Manulife and Marco Polo. We'll try to add more before we end the year. I think we saw some requests for construction. We'll try and ask them again, and hopefully they will try and do a webinar with us before the year ends. Next slide. We'll move on to Phillip on the ground. So not many briefings. So we had one on Fortress Minerals. So they are iron ore producer, one of two in Malaysia. The earnings are generally basically flat, but that includes the unrealized FX gain. So prices are down, but I think you will notice the red line here on the left, the prices actually come back up to 110. So they should benefit from higher prices. They have one producing mine site, which is Bukit Besi in Terengganu. Production should increase 20% as they add 2 ball mills. So just to give you an idea, what happens in the iron ore is that they will have a boulder, then they have many processes, they have a crushing plant, then they have a ball plant just to basically crush all the boulders into small little like ball bearings that they will supply or powder form to supply to the customer. So they're adding capacity, but the other main story for them is that they have three sites that they are exploring. Mengapur, the one in Pahang, is a bit more advanced. So probably in 2 years' time, they will probably going to have iron ore and also copper, but they will probably need to raise some funding here. We guess it's possibly 40 to 50 million. And Sabah is still exploratory work. So for this company, it's more like firstly, you got to believe that iron ore prices are going to recover. And then the big growth for them is if they can fund and grow because they're moving away from iron ore to copper. Next slide. Okay, this one is just a complicated chart, but since the election is coming closer, just to give you a sense of what the two candidates plan. So this is from a bipartisan, you can just go yourself, this Committee for Federal Reserve, but their highlight is this. So based on the two candidates' plans, again, these are all really guesstimates because they don't really give details. But so firstly, what are they spending on? So for Trump and Harris, they're going to, as you all know, there's this Trump tax cuts or the TCJA. So this will expire. A lot of the allowance, as an individual, you got tax allowance. So a lot of this will expire in N25, but Trump going to extend everything. And then the bottom bar box here is that Harris going to spend more on healthcare. But just to sum it up, because a lot of lines here, but just to sum it up, what Kamala wants to spend on is on children, on healthcare, on education. What Donald Trump wants to spend on is lower taxes, cut tax for corporate, cut tax for overtime pay, cut tax for security, and spend more on defense. So you can see the vast difference between both candidates. But what will impact us more, I guess, for Singapore Asian equities is how they're going to fund this negative 7.2 trillion and negative 10 trillion over 10 years. So Kamala will fund it through higher corporate tax. So they're going to raise corporate tax from 21 to 28. All this will be negative for the market, US market, but it's not going to be easy for her to implement tax cuts because you still need the Congress approval. And most likely the Congress is going to fall to the Republican hands. So a bit harder for her to raise taxes. But on Trump's part, what he wants to do is a universal baseline tariff. So he's going to hike tariff by at least 10% on most imported goods. And this will obviously impact Southeast Asia, Singapore. And he's going to impose 60% tariff on all Chinese imports. So this will impact the whole Chinese story, the whole Chinese equities, because it will slow US growth. So that is probably the danger, the tariffs, because he wants to fund all this, not fund, I think he can fund most of it, not everything, but he's going to fund part of it through higher tariffs, and he's going to raise tariffs on Europe, and it would probably just trigger a trade war. I think every country is just going to impose tariffs on each other. It's not going to be good for our economy, not going to be good for companies like SAS or transportation or exporters, or the whole transportation supply chain will be affected. I mean, if there's really a big trade war happening. So that's the big danger if he gets elected. Next slide. Okay, this one is just the inflation. So what we worry, if you do a trend line, we worry November and December inflation might perk up. So this is going to be negative. I mean, it will just create worries that the Federal Reserve may not raise rates so much. Because what happened is that if you look at last year's numbers, last year inflation dropped very sharply in November and December 2023. So you usually get this base year effect. So this might actually prop up inflation. The real steep drop in inflation in the US will probably come in early 2025. Again, this is just a trend line. It's not. We are just extrapolating the current trends. So you notice there's a bit of a bump up in November, December. So don't expect strong inflation numbers coming in November, December. So this is the current trajectory. How you read this is that the blue line is what the market expected in September. Then in just 10 days, the expectations jump up. The futures market pricing of interest rate cuts is always very volatile. So right now, they are more or less following where the Fed is. If you look by December 25, the blue line and the red line is all converging. So what we are looking at is that market is expecting, just like the Fed, 2 more rate cuts in coming up. So we still should expect 2 rate cuts coming. Then another 4 rate cuts coming in 2025. But that will be a bit less certain. I mean, because we're probably going to get the November, December scare. Next slide. If you move on to the left, you just notice export. So export growth is a bit stalling. So what we think exports is why doing so well, and probably why the Singapore GDP did so well. So there's a lot, I think we mentioned before, but there's a lot of front loading by the US importers. They are building up a lot of inventory in view as worries of a trade war happens. So there's a bit of stocking up. So we also agree, we think there's a bit of an anomaly in terms of the strong demand in exports. The one on the right here is just to show we actually monitor the monthly sales for contract manufacturers. So the one that's doing well is Hon Hai. You notice this blue line here on the right, it jumped up a lot. So then mainly because Hon Hai is supplying a lot of AI servers. So unless you're doing anything related to AI, most of the electronic sector isn't doing exceptionally strong. Yeah. Next slide. So this is just a chart on palm oil. If you look at this, you notice the red line is the palm oil price is rising, even though production is actually growing. So this blue line is the inverse. The one on the right here is just to show, this comes from Bloomberg, they take it from this. So this is basic crush margins. So the blue line here is the crush margins that for the industry and probably for Wilmar too. You notice the crush margins was negative 500, but it's now positive 50. Mainly because hog prices are rising, and also although it came off a bit, but it has been climbing up since I think middle of 2024. The red line, and also soybean prices are coming down. So they said the margins for the industry is improving, and this should be positive for Wilmar. Next slide. This is my last slide, just to reinforce the reason why the ECB, we should be positive for Cromwell, why the ECB can cut rates. If you look at the red line, in their CPI is now 1.8, below their target 2%. So that's why they can cut rates. And one way to gauge how tight the monetary policy is to look at the orange line. That means the interest rate, and then you just adjust it for inflation. So you notice that the orange line is probably the highest in almost 25 years. So there's room for the ECB to cut. And the European economy isn't like tail spinning. You look at the unemployment rate, but I guess Germany is the one, the exporters are facing the pressure. Again, we're not European experts, but just to give you a flavor what's going on. Next slide. I think that should be the last one. Okay, thanks everyone. I think we'll move on to.
Yeah, let me take some of it. Quite a few banking questions. Hold on, just let me scroll up all the way. Okay, someone asked, because I think I mentioned it a couple of times. Someone said, can explain in layman's term what is carry trade impact? Thank you. Yeah, so this is, I wouldn't say it's really old news, but it happened in August. So just very briefly, I don't want to go too long or too much detail on this, it'll take forever. But basically, investors will borrow money in a country with low interest rates like Japan. So they had almost 0%. So it's like essentially very cheap, it's free money, right? Invested in a country with higher interest rates like the US or even like Singapore to make a profit from that difference, right? So what happened in August was that Japan raised its interest rate slightly, right? Just by a little bit, but that actually caused the borrowing in Japan to be a lot more expensive. And this reduced the profit that they could get from these, what you call these carry trades. And what happened and what was the reaction was that the investors started pulling money out of these trades very quickly, and they caused a sudden drop in stock share prices globally. So Singapore was also affected by this as well, and you could see that in the banks also it was quite badly affected during that period, right? But I mean, some could say that it's a good time to go in, right? Because now we have seen that ASG recovered even stronger. And the main reason why is because many of the investors were using the yen to invest in higher yielding assets, which is why this led to this rapid unwinding of these trades. And there's this very high market volatility and a spike in the value of the yen as well, which you saw. Yeah, hope that helps you understand better what this carry trade impact was. Yeah, and I think going back to my point is that the banks have actually more than recovered. So before this happened, the banks were like somewhere here, but now they have recovered even past that stage. So that was my main point that I wanted to bring across. Okay, someone asked also, because I was speaking about the bank's AUM and fee income, someone asked what figure is in the bank's balance sheet? Where do you get this figure? Yeah, so interestingly, for the bank's AUM, they're not required to say what it is, right? But where we find this information from is from the presentation slides. Every quarter, they'll have a investor presentation, to analysts and to the public as well. You can find this, it's all publicly available information. You just go to their investor relations and then you can see it. It's in the slides, not in the statements. And then they'll put it in one segment there. If you search for AUM in their PowerPoint slides, you can find that figure, right? So what we have to do, or at least what I have to do, is that we have to track this every month to see how well their AUM is doing. And they're not required to give this figure every quarter. Both OCBC and UOB, they do give it every quarter, but for DBS, they only give it every half yearly. So which is why the figure may not be updated as fast as the rest of the line items, revenue line items, which they have to give. Yeah, hope you'll be able to find that. If you can't, you can just drop me an email and I can just guide you to where to find it. Okay, I think there's one about Wells Fargo. Yeah, so Wells Fargo also released their results the same day as JPMorgan. So Wells Fargo, they didn't do as well, right? Their earnings were down, revenue was down. But why did it perform quite well is because they beat the estimates, they beat Wall Street's expectations. So which is why the share price improved quite well. And I think what was the main factor that caused their earnings and their profit to decline as well as revenue to decline would be the net interest income. So net interest income, their cost of funding went up much higher than JPMorgan's, which is why their net interest income actually declined. But interestingly, if you look at their fee income, I mean, of course, it also improved. I think it was double digits. But what was I think quite the differentiator was that their provisions didn't move as much, like didn't increase as much as compared to JPMorgan's one. So the provisions was quite stable. So that's one of the positives that we can take away from Wells Fargo. Oh, sorry, I lost that question. Oh, okay, yeah. I think someone asked also, can we expect strong results from Bank of America like JPMorgan? I think for Bank of America, it'll be quite similar. It should be in between JPMorgan and Wells Fargo. So, their net interest income, I don't expect it to improve year on year like JPMorgan, but their fee income will be improved. I think the main key factor and the differentiator will of course be the provisioning line and how well they can control their expenses. Yeah, so those two will make them different from their peers, basically. Yeah. And also I do feel that their net income and their earnings as well as their revenue could possibly decline year on year, but whether or not they can beat the estimates, we'll see how well that will fare for Bank of America's share price. I think there's a few more. Moving back to the Singapore one. Sorry, give me a minute. Let me find it. Yeah, there's a very interesting question here. Hi Glenn, OCBC's share price is more than 50% lower compared to DBS and UOB. Can you give your view on what OCBC is lacking and what they roughly need to do to up their share price? Yep, so I don't think looking at just the share price alone will be a good indicator of whether the bank is lacking something or is not doing as well, right? We always see DBS as the largest Singapore bank and then OCBC as the second largest and UOB as the third largest or the smallest. But even though their share price is lower than UOB's, but we look at the market cap, which is what we see how big the bank is, right? So OCBC's market cap is larger than UOB's, right? It's below DBS's. And another thing we can look at is also the other ratios, which is I think a more of a fair way to compare the banks, like the price to book and price to earnings. So if you look at price to book, which is what we use to compare the banks, DBS of course is way past the other two, but UOB and OCBC are relatively similar, and they have been closely pegging to each other for quite a number of years already. They're always very close to each other, and currently they're I think neck to neck, right? Of course, DBS the share price has run up, so it's way above. Yeah. So if you look at the price to book ratio, DBS, OCBC and UOB are actually almost they're at a tie now. Yeah. So I don't think that is just the share price alone can say that the bank is not doing well. I guess the only thing is they can say that the stock is more affordable, right? If you look at it, if you want to buy one lot, it's cheaper than buying DBS and UOB. Let me see if there's any more questions. I think that is the last one. Oh, okay, sorry, there's a follow-up to this. Does this AUM that I mentioned represent AUM managed by their private banking units? Yeah, I think it is a combined, so it's not just the private banking, it's also their wealth and everything. Yeah, it's their full AUM. Yeah, it's a combined AUM that they put the figure there, which is why it's very hard to get it from the balance sheet, because balance sheet they do not it's all over the place, right? And whether or not you are taking the right figure is hard to say. So hence that's why this figure is only provided by them during the presentation and during in the slides only. They don't do it in there's a line item in the balance sheet where you see AUM. Yeah. So these words are AUM stands for assets under management. Yeah, for those who are curious. Yeah. So it is a total figure of whatever assets they have under them. Yeah, you're right. So someone also said, yeah, sorry, I forgot to mention this earlier. Someone also said that OCBC's share price was lower due to some share split sometime back. Yeah, like DBS also did their 1-for-10 bonus share issue, which is why you see their share price drop. But market cap has actually continued to grow, right? So that's why I think to look at a bank and how big they are, right? We look at the market cap, not so much the actual share price, and we compare like DBS share price to OCBC share price, then that's not a fair sort of comparison. We look at the market cap to see how large the bank is. Someone asked, is Credit Bureau Asia related to China? Let me get back to you on that. I'll have to do some checks. Yeah. I'll hand it over to the rest. I think that's all the questions for the banks.
Yeah, thanks, Glenn. Let me try to take a few questions as well. There's one here. How does generative AI impact Google or Alphabet? Two fronts. Firstly, for their digital advertising business, it's more of a indirect benefit because what it does is it improves it basically improves their products, right, which leads to better performance, better effectiveness, which leads to higher prices. So that's one. And on the second prong, which is a little bit more direct, it's on for its cloud business. So because Google is like all the other hyperscalers, they're the largest cloud providers, and they have got quite significant AI infrastructure, AI capabilities. So what we're seeing right now is that there are a lot of startups and smaller businesses that I say smaller, but still fairly large. But especially a lot of these AI startups, they require they don't have the capex to go and spend on building a new data center, and B, they don't have the time to go and actually build it out, because building one takes, like building anything else, takes time. So what they do is that they leverage on services that are provided by hyperscalers, like Google, like Amazon, like Microsoft, in basically renting their cloud services, renting their GPUs. So I guess it's kind of like renting an apartment. The more companies there are, they need to rent to house whatever tech capabilities or whatever development they need, then they'll go to big hyperscalers. So those are the two main ways that generative AI actually impacts the company. Hope that helps. The second question here is, any expectation for ASML TSMC results this week? Yeah, so for ASML, they're notoriously lumpy in terms of their revenue growth, just because of their order intake. And so what we really look out for is for the order book, whether there's actually not we predominantly look at over the trailing 12 months, whether just to smoothen it out, whether there's any what the general trend is. But for ASML, because 50% of their revenue actually comes from China, so what we'll likely be focusing on is whether the latest news is that the Netherlands is imposing more tariffs to China and export restrictions. And so that could significantly impact ASML's business model, because they won't be able to export out of the Netherlands into China. And that could affect the revenue at this company. So what we'll likely see is see if there's any commentary on that, how that will affect moving forward the business model, especially in terms of revenue, right? Because China makes up such a large component of ASML's revenue. Yeah, but otherwise, expectations, remain fairly high. I think expectations for most semicons would be fairly high, given there's a lot of talk about AI, about demand, and at the same time, the overall semicon industry is in recovery. So there's probably more upside there and higher expectations as a result. For TSMC, expectations are high because they are the main supplier of chips to, they're the main foundry, right? So they supply all their chips to all the big companies, NVIDIA, AMD, Intel, and maybe not so much Intel, but Qualcomm, Broadcom, all the comms, right? They've always stated that demand is extremely high. At the same time, they have significantly improved their or rather establish their packaging, their CoWoS technology, which is needed to improve the yields for quite a number of their high, especially for their AI GPU chips. So expectation for TSMC is high. Likelihood is given that they announced their monthly. Just in case you didn't know, every month TSMC will come out with their monthly shipments and revenue. So just based on that, you can kind of estimate how well they'll do it. And so far, based on the numbers, they're doing really well. So we think TSMC will continue to do well, especially when they announce their results. I think on Thursday or Wednesday, this week. See this. So Alphabet, any more comments on why its recent share price has been around 160? Is market concerned about antitrust issues or any others? I think predominantly it's just antitrust issues. I think when you look at similar advertising companies like Meta, right, it just continues to fly and make all-time highs. Because they don't really have this DOJ overhang. So we think it's predominantly due to that. There's another question here. Tesla robotaxi looked toothless. Uber share price jumped instead. What are your thoughts? I also saw the Uber share price. I think it was up by 10%. It's a significant jump. But when it came to just your robotaxi event, it was great because it was good because it kind of shed light and gave some timeline on what could happen, especially with robotaxi. The timeline about rolling out next year with its Model 3 and Model Y. Later 2026, 2027 will be when the robocar starts to really get into production. The only thing is that they in the past Tesla has always come up with these kind of brand timelines and they've always missed it. So I think market is really just discounting the timeline quite significantly, especially with the robocar. The one thing that was missing was an announcement on its low cost, or rather, the market expected Tesla to launch a low cost EV, which is priced below $20,000-$30,000, just to compete with some of the other EV manufacturers, especially at BYD. And essentially, I think if you really want to get into a mass market, you've got to bring the price down quite significantly. But there was no mention of that. Instead, they were just focused quite heavily on the robotaxi. So it's like essentially a robo car and the van, robo van. You call it robo van, but whatever. It was like your 20-seater or 15 to 20-seater van. So it was more, I guess, more of a sales pitch, less of a. It gave some indication, but really not much direction in terms of its core EV business. So I think that was the biggest miss there. In terms of Uber share price jumping, I think it was really around the hype of robotaxi because in its latest earnings or second quarter earnings, Uber actually talked quite a bit about being in contact with some of these autonomous vehicle companies that are looking to use leverage Uber's platform. So I guess with that, robotaxi timeline of next year, the market was just kind of pricing in the potential revenue gains from Uber. Because technically, the robotaxi is not actually the first of its kind. I mean, like Waymo and other kind of autonomous driving technology. So we could see these programs rolled out and revenue share, especially if a lot of them want to partner with Uber for Uber's scale and platform. Then Uber will be it's like no cost to Uber, right? All they do is provide a platform. Just the margins that they earn from that revenue is massive, especially for their own company. So I guess in a nutshell, that's my thought on the actual. I hope that helps. I think that's all the questions from me. Let me scroll down to see if there's any more. I think maybe I'll hand it back to the rest of my colleagues to take some more. Sorry, before that, there's a question here. What sector does NVIDIA come under, tech or semicon? So actually, it comes under tech. Semicon is actually not a sector in the S&P 500, but we just took it out because there's so much hype around it. and it's quite a large sector if you take out all the semicon companies. Yeah, but it's not officially a sector under the S&P 500. So it will fall on the tech. Hope that helps. Okay, I'll hand it back to the rest of my colleagues. Thank you.
Yeah, let me answer the question on, please kindly explain the Fraser's Hospitality Trust Managed Investment Trust status in Australia. Thanks. Yeah, so basically what happened there is that because of the share swap back then in, I can't remember the date, I think completed September if I'm not wrong. Yeah, because of the share swap between ThaiBev and TCC Asia, as a result, TCC's effective stake in FPL, it rose to 87%. And because of that, the managed investment trust, one of the requirements to qualify for that interest of 15% is basically the foreign individual cannot hold an effective interest of more than 10% in the Far East, in Fraser's Hospitality Trust. And because of the share swap, TCC now owns 87% of FPL, and as a result, they own TCC owns an effective interest of more than 10% of the Far East, sorry, not Far, I keep saying Far East, of Fraser's Hospitality, the Australia subsidiary. So as a result, Fraser's Hospitality now they will have to pay Australian tax rate of 37.5% instead of the withholding tax rate of 15% if they qualify for the concessionary withholding tax if they qualify for the withholding MIT. Yeah, so basically as a result of in simple terms, as the ThaiBev and TCC share swap caused this so-called mess. And basically, you just need to know the result of this is that they Fraser's Hospitality, they have to pay a 37.5% Australian tax rate from the income from Australia instead of the 15%, which is a concessionary tax rate. And based on that, there's the preliminary review of the unaudited results for FY24. This impact would affect DI, the FHT's distributable income, by about 1.3 million. So that is about a 2.5% reduction to the FHT's reported DI. Yeah, so roughly, I know it's a little bit messy, but yeah, basically that's the impact. So they have to pay higher tax for the Australia subsidiary because because of the fact that they so-called breached the foreign individual cannot hold an effective interest of more than 10%. Yeah, and they breached this because of the share swap basically. Yeah, I hope that explains that. And one more question for me is I think there's one. Good morning, team. One is AIMS Apex unit price performance such a laggard. What are the weakness with AIMS Apex here? Yeah, so AIMS Apex, there are no new developments. So basically, the share price have been trading around $1.25 to $1.30. The weakness for AIMS Apex here is, in my view, is that rental reversions for them, we've seen very strong rental reversions for them over the past few quarters. We think going forward, the rental reversions will slow down to low teens to high single digit. So we've seen their logistics and warehouse properties having reversions of 21% for so many quarters in a row previously. So with the slowdown in rental reversions, I think that's probably one of the reasons why there's a little bit of weakness in their share price also. Yeah, I'll hand over the rest of my colleagues. Thanks.
I will take on the SaaS question. What's the reason for the share price for SaaS to drop? So there's no particular news on SaaS, and we believe like it's probably people are trading on the result, which will be like earlier November, so next month. So essentially like we believe it's pretty much like all the catalyst has been long pressed into the current share price, such as SAA contract renewal and also increasing air cargo volume. So although like air cargo volume is still on the upward trajectory, like the global air cargo demand by cargo tons kilometer grow by 11.4% year-on-year in August. Yeah, but it's just not a new news to everyone anymore. Yeah, so overall we think like after all the pre-result report released, the buy side just feel like the company is running out of the new near-term catalyst. Yeah, but we still believe the next result, the result for the upcoming quarter will be good. Yeah, since SIA contract renewal will be taking effect. And there's also like it accounted for 70% of the total revenue. And also the increasing cargo demand would benefit SET's gateway service segment, which accounted for around like 77% of the group's total revenue. Yeah, hope it answers your question. And for 17 Life, we had a settlement with music copyright and an impact on the stock. Yeah, so there is an ongoing settlement with a Japanese company regarding copyrights, and we believe like highly likely 17 Life will lose the case, and then so they'll pay the copyright fee, but it's a one-time charge. And this will be like after so on P&L, this will become after operating income. Yeah, so it just won't hurt operating income at the year end. Yeah, but we do expect a fair bit amount for the copyright settlement fee. So roughly it will be like around 15 to 20 million. Yeah, so since like the valuation method we use is DCF, yeah, so valuation will drop with the lower cash position, and we have already factored in into the model. And for Zixing, where is it? Yeah, so Thomas have been buying a lot of the Zixing share recently. Is it good for the stock? Yeah, so Thomas has continued to increase his stake in Zixing, and essentially he become like substantial shareholder recently with holding above 9%. And yeah, so he has been buying more, he has been taking more shares after he met the CEO. And we feel like he's pretty much convinced by the improving fundamentals of the company. And we do view it positively. And like more likely they are investing into the company for the medium to long term instead of like just trading on the result. Yeah, but we still believe the next result to be exceptional for Zixing, given like this has substantially lowered the spoilage rate, and also therefore we're expecting 30% increase in sales for their processed product, and also 70% increment for their fresh product. And yeah, we do expect PATMI to double in this financial year. Yeah, hope it answers your question. I'll hand over to Paul for the rest of the question. Thank you.
Yeah, thanks very much. There were some requests for webinars for Tiongwoon and also Pan United. So thanks for asking this request, because sometimes we're not sure what investors or attendees want. Of course, you know, you can't get the big banks and all that, but smaller mid-cap names is easier for us. So both have agreed. We're just planning the logistics when they will do the webinar. So it's likely it's likely November, probably end or middle November for Pan United and Tiongwoon. But thanks for sending in the request. Mars has a meeting in the morning. What light did they share on Singapore interest rates? I didn't go. Sorry, I didn't go through the details, but I think it's just a continuation of the existing monetary policy. I'll do a slide to next week. So I didn't have time to go and run through some other meetings, so I didn't really see it. So sorry for that. But yeah, I think they just continued the usual gradual increase in the Singapore exchange rate against the weighted average of their trading partners are the usual thing. I mean, 1-2% increase in the weighted average. So sorry, I don't have the details of me. Hi, Paul. Singapore GDP 4.1%. B estimates. MES maintains NER. Any thoughts on this and any impact on the sectors? So the impact, I don't think the market, like Singapore market, will just run because the GDP will jump so high. Firstly, because the benefit is manufacturing, And we think there's a bit of front loading of manufacturing ahead of elections. I mean, that's our own view. Secondly, the sectors that will benefit should be banks. I mean, in general, banks, mainly because, a strong economy, healthy economy will benefit the banks in general. Because this is a very broad, they don't really pinpoint which sector to go buy AEM because manufacturing is doing well. I don't think that's a good idea. The second thing is, banks do benefit if the GDP is up. So there is a computation in the banks. They call it expected credit loss, which is their general provisions. So if the GDP is higher, they might kind of lower down their expected credit loss or general provisions. But again, the general provisions are really very low because there's really hardly any bad debt in Malaysia. But I mean in Singapore. So there is some benefit to that sense. But I guess if there's one beneficiary you have to kind of link in, it will be the banks. How was the Chinese Finance Ministry meeting on Saturday? It seems to be disappointed. I didn't go hear it, listen to it myself, but I guess there was lack of details. I think the market might be worried that how much can they actually stimulate because of the high gearing, the high leverage in China. My own thoughts is that if you look at property and property related, is maybe 20-30% of GDP. If you assume half, if you assume next year property construction really contract by half, they probably need to stimulate by almost 10%. I don't think they have the capacity to do so. Maybe they will stimulate just to stabilize the economy, but to make it grow very strongly, I don't think so. Maybe that's why they need this so-called wealth effect through the stock market and so forth. I mean, that's my own limited reading of it. But again, my worry is that if Trump comes in, then I think all the Chinese equities will be sold off because I think the expectation is that he's just going to implement immediately because he can do it under national security once he becomes president. He doesn't need the House to approve it, the Congress to approve. So once he becomes president, T+1 second, he can just impose tariffs on the whole of China, on all Chinese imports. But of course, the news of him being elected will probably going to hurt the Chinese stocks. I mean, that's my own view. Is Yang Zhejiang arbitration news material? Yeah, it looks material. I think the penalty is about 800 million, if I'm not mistaken, if I read it correctly. Sorry if I get this wrong. But the other thing that's hurting is the container prices have come off. I didn't do a chart, but I think it's down 20% month on month, if I'm not mistaken. I need to get the number, but container freight rates have declined quite sharply. I think in view that the port the port activity, the port strikes have eased, and again, sorry to keep talking about this. We think the front loading has probably caused the rates to climb up higher. So that's why, and also the share price is up, I don't know, 60% this year or 50-60% this year. So all these factors probably causing weakness in the earnings. Yeah, I mean in the share price, right? PopGov is still loss-making last week's results. Will they turn profitable? I was in and out of meetings, so I didn't hear exactly, but I think the outlook is positive for TopGlove. Mainly because China, there is a jump, there is a 50% import tariffs on Chinese gloves effective beginning of next year. So, and the Chinese don't seem to be raising their capacity. So, and actually TopGlove is raising their capacity and their utilization is rising. So one of the reasons they went to loss is because the ringgit strengthened a lot. So that hurt margin. So the outlook from them seems to be more positive next year because basically the Chinese are locked out from the US market. And then when there's lockout, of course, what it means is that US healthcare gloves will have a bit of a shortage, so they can command higher premium in the US market. So that is what was the key message from that. And of course, the worry is whether China will dump into other countries. They may shift production up, but it will take time. You can't just shift off from US, then suddenly look for a buyer, just transfer. So it might take some time to adjust. And from TopGlove's management, I think their view is that the Chinese don't seem to be raising much capacity too. So the outlook seems to be more positive for gloves. Again, this is their comment from them. But the main news is the US, so they should have better margins out of the US, which is of course the biggest market for gloves in the world. CPI, PPI, jobless claims all higher than expected. Rate cuts for the rest of the year derailed. I don't think so. I think in a way the Federal Reserve has also probably put themselves in a spot now. So there should be one more jobs report coming in November. Because of the hurricane, that jobs report should be expected to be weaker. So that probably gives the Fed cover to cut rates in November. So they will probably want more job report. I mean, the expectations is because of all the weather disruptions. So that should cause because when you send a survey, they don't reply. So so they probably just keep the old survey. So I think there's some technical reasons why jobs numbers should be weak as we approach November because of all this hurricane disturbance. So we still think there'll be one more cut. Then after that, then that's where it becomes a bit more cloudier. If interest rate cut benefited utilities, how come Keppel infrastructure price is not improving and the dividend give? I really don't follow Keppel that well. My 2 cents, probably 1 cent view is they just did a placement. So and the placement is 60. The placement is below this price. So I think there'll be overhang. I mean, if you want to buy something, yeah. So I think that probably is the reason. I will attend their next briefing. Then I will try to give more clarity for everyone. Since we got so many questions, so apologize, Phyllis. I can't really give a really good answer for you. Latest SG financial estimates were said to be pointing the construction sector will be slower for this quarter. What's the impact? I think no issue. I saw the latest number for the construction. I didn't put it up because there was a 2-week-old. But the construction contractor awards are still climbing to new records. So I have no worries on construction. It's pretty clear. And this is before T5. So T5 award only in the first quarter of next year. So even before T5 come out already, the construction contracts awarded is already a record high. So I wouldn't be too worried. I'm not sure what was the messaging. Maybe it was very strong in third quarter, so a bit more slowdown. But based on the contracts awarded, hopefully I'll try and show you a chart next year, but next week, but it's still still growing very strongly. So no issue on that. Yeah. Next year will be even stronger because you got T5, the IR. Maybe it might peak next year in terms of growth rate, but not this year. Yeah. And hopefully with Tiong Woon and Penn United coming to do webinar, you can ask the same question and see what they say. Thanks. China CPI PPI released on Sunday before estimates. This is deflation. Yeah, I guess I didn't see the number, but apologies. Yeah. And yeah, it just gives them more room to cut interest rates. But if you are in a balance sheet recession, you will follow what Japan happened. I think we all know when interest rates are so low, also they will still deleverage. So even though the bond yields in China is like 2%, they can still sell a 50-year bond of 2%. That shows, I guess, the pessimism for investors. Yeah, because in the past they only could buy property. Now, yeah, they're shifting it to safer assets. Yeah. Was Singpost news on Australia last week good? Yeah, I think there's just a rumor of them selling to BlackRock. I think 1 billion. I think that was there was a news article on that. I think on Singpost. On the speculation. Yeah, I have really no comment on that. Yeah. It was just some speculation in the Australian Financial Review. I think that the BlackRock was looking at it. Please comment on PropNext and HRNet. Okay, so PropNext we still expect. Okay, by the way, they're doing a webinar, so please ask them that too. But for PropNext, we still like it. I think they have a 6% yield, and there is a recovery expected and it's underway in the second half because there'll be more new launches. And the good take-up rate at Mayer that we saw, the 50%, it is a positive for the sector. When they when they do this selling of new property launches, you need momentum. You know how it works. So when the earlier property launch did well, then you will tell, hey, see, Mayer did so well, 50% take-up rate. I think that no, you should consider this new launch. And so it builds momentum. I think that's what the agents tell me too. So it is definitely positive when there's a new launch that did well. It builds momentum for the next upcoming launch. So this will be positive for Propnex, and I think the resale is doing well. The problem is that we very hard for us to track the resale number, but I think there was a news article on the weekend that I think resale volumes are still growing at 10-11%. So we are positive on Propnex. I think for the second half, and the next year could be better because there is a 25th anniversary. And again, you can pose the same question to them, and I won't be surprised if they announce a special dividend next year because of their anniversary. For HRNet, I think it will be slow, although they mentioned that the hirings are slow, so we don't see any pickup in hirings. The labor environment is still sluggish for Singapore based on the latest data. I know there was some pickup in the third quarter, but because there was some restatement, I actually sent an email to the Ministry of Manpower to check their numbers. So they did do some restatement. So it was just the way the upside was because they restated the small business numbers for hiring. So I need to see the fourth quarter. I don't think the job market is improving. So that's why you don't expect any strong recovery for HRNet. For Fortress and Southern Alliance, which one has a better fundamentals? Taking a pinch of salt because I didn't really see Southern Alliance. They don't really do any analyst briefing. So I'm more comfortable with Fortress. I know there's a request for them to do webinar. I asked before. They said not yet, but let's ask again. So I'm more comfortable with Southern Alliance because I know Fortress Minerals because I know them better. Southern Alliance is a bit of a black box for me because they don't really do any briefings. So for me it's Fortress Minerals. Yeah, I remember it raised. Thanks for the reminder. Yeah, I did ask before, so don't worry. We do ask the corporates. Sometimes they're not ready, but let me just ask again. Yeah. Let me answer this last one. I know there's lots of questions. Sorry, some are not that familiar yet to answer. Trump or Kamala better for Singapore market? Okay, this is not a political question. This is just for market view. Kamala should be on paper better for Singapore market. There's less risk of a trade war. There's less risk of tariff hike. And with Kamala, there's also better chance of a divided government because Democrats will control presidency, and then the Republicans will control the Congress, or basically the lower house and the Senate. So basically it will be status quo basically under Kamala, no major changes. So that's why as an investor, that will be the better option. Okay, yeah, thanks. I'll hand it over to Zain. Yeah, thanks everyone for the question. Sorry, some I can't really answer. We'll try and get back to you on like capital.
Thanks, Paul. I'll share my screen now for the TA. So I'll go through some of the Singapore, Malaysia, and Hong Kong counters first, then followed by the US ones. First question I see is HP Group listed in Bursa. I think for this currently looks like some consolidation taking place between 54 cents or 62 cents area. So I think for now, I think nothing too much, just some sideways consolidation likely for the time being. Then for YTL Power. YTL Power, I think price is still trending down in this downwards channel over here currently. Could see a bit of a sideways currently because this area around 330 to about 350 was previous range support area. The price currently bounced from there. We'll expect some range from there. We might see some bounce if price is able to get above this about 380. But near-term resistance likely be around $4. So probably some sideways consolidation as well. And then for critical holdings, I think there's seen a bit of a rebound taking place since price go above 87 cents as well as the 94 cents levels, I would expect some resistance to come in around $1.05. This previous range resistance. So probably quite sideways as well, these critical holdings. Yeah, then I'll move to some of the Hong Kong counters. First up is Tencent. Okay, Tencent, we've seen a bit of a pullback in general, all the Hong Kong listed counters. I think for now, likely we might see some sideways taking place because they are looking at the short-term moving averages. A bit of a large short-term double bottom today, around at a 424 level. This is near the 20-day MA as well. And yeah, so these are a bit of overall supports currently, but I will expect resistance coming at 450 in the near term. So maybe some sideways consolidation slightly for Tencent in the short term. And for JD, you can see a bit of a looks like a bit of a sideways range as well. Price hit a bit of first support level at $150, single bit of a bounce. Then I think short-term resistance around 175, then followed by around 185. So maybe some consolidation, a bit of a sort of a bullish trend for the time being. And then for Ping An Insurance, also looking quite similar. Current resistance likely be around 54 and then followed by 58. Hit support level around 46 and currently doing a bit of a bounce. So maybe some sideways price action as well for Ping An. Okay, then for 3191, it's the global China semiconductor ETF. So for this, I think some weakness. Price is broke below this previous resistance level around 42.50. Still some weakness going on. I would think price could go a bit lower. Next support level is around $37, then followed by the stronger support level, which was a previous horizontal resistance, is around 35. So 35 to 37 might be the next support area it could touch first before some rebound, since there's still no sign of any sort of a rebound coming soon yet. So price might go a bit low. The next one is 2801. 2801 is the iShares Core MSCI China ETF. So for this, I think there are some weakness currently as well. Finding some resistance at $23, which was this level with a price book of on support and currently turning into resistance. And then first level of support is around 2160. So maybe some sideways consolidation for the time being. Then if price builds a whole, we might see a bit of slight weakness towards closer to about $20.50 the next support level, which also has this price gap over here as well. Okay, next one is for Zixing. For Zixing, price was quite sideways previously. It hit a resistance around 0.031 about there. Then we saw it break below this support 0.028. Finally, filled this price gap 0.025. I think this level is the first level of support in the area. However, resistance likely to come in at 0.08. So maybe some sideways consolidation over here for the time being for Zixing. Then for Yangtze Financial Holding, price pulled back to retest this previous range consolidation resistance at 40 cents and seeing a bit of a bounce today, but some resistance currently at 41.5 cents area. So maybe some consolidation. If price is able to get above 41.5 cents, then next resistance level it could retest is the highs, I think last week around 43.5 cents. And next support level below this 40 cents would be 38.5 cents level. Okay, then for Sheng Siong, some strength recently, price broke above this resistance level 155, currently to be testing around 159. So over here might see some slight sideways afterwards. If it continues to hold higher, higher lows, we could see the uptrend continue towards maybe 162 and 165 for Sheng Siong. Okay, then there's also a question on Hang Seng. So for Hang Seng, I think there are some pullback currently, and you can see some sideways price. It's still finding some currently slightly below the 5 and 10-day moving averages. So say the 20-day will be the next support area, which is this around this price gap around close to 20K. This price gap psychological level as well. So and then current resistance will be around 21,500 around here, this level. So maybe some sideways consolidation for the time being. Okay, then some more Hong Kong counters again, 952. So for 52 currently looks like price pull back towards previous resistance area, which is around 95 to about $900 area over here. And then seeing some supports coming in with a lower wick. So maybe I would think price will hold over here for a while and do some sideways consolidation. Near-term resistance is around 105, 106 these areas for 52. Then for Meituan, also some pullback towards first level of support around 177. Price is doing some and bounce off it and some sideways consolidation. Near-term resistance is at this horizontal level at around 200, about 211 this area over there. So maybe some consolidation for the time being. And then there's question on CICT sets and CCT. So for CICT, yeah, it's generally still quite sideways in this uptrend channel in blue. Yeah, price has just been consolidating between $2.08 to about $2.16. Then there's also some support at around 205 as well, which was the previous resistance. So I would still expect price to be quite sideways in the range for now. Okay, sets, I think sets, I think last Friday there's a bit of weakness coming in. Yeah, price was had a range breakout earlier. But however on Friday there was this bearish candle with volume Friday breaking below this breakout at 373. To actually retest this the range support level around 355. I think for now price needs to get above this 373 level again to actually continue an uptrend. If not, if it breaks below this level at 385, I think we could see some further pullback process. And next support level will be this at around 349, 350. And then for CapitaLand China Trust, seeing a bit of a pullback from this swing high resistance at 87 cents. However, I think it's nearing a support. Previously, we have this some resistance at around 78 cents. 78 cents area confirm this upward support line over here as well. So around here, 77 to 78 cents, I would expect some support to come in for a slight bounce. And near-term resistance will be around 82 cents, this horizontal level breakdown. Okay, then next up, Fraser Centerpoint Trust. Okay, for this, I think seeing some pullback recently as well. Price couldn't hold this support level at around 230. So we're seeing a bit of further pullback. I think we might see price trend slightly lower towards about 222, 223 area, which was a previous strong horizontal resistance. Confirm with this upward support line that will act as a support. So I expect some bounce if price comes to this level over here. And then for Wilma, I think, yeah, Wilma is looking better recently. Price broke above this downward resistance line through the consolidation. Currently is quite choppy sideways. But if price can continue to form higher highs, higher lows over here around 330, and then confirm a breakout of this downward resistance, the longer term downward resistance line, then I think could be quite positive for price to go up higher towards next resistance around 354 for Wilma. And then for CDL, I think CDL a bit of weakness recently. Price still finding some resistance from this downward resistance line over here at 550, 545 around there, and then also below this resistance breakout at around 530. So yeah, some slight weakness we could see, maybe a bit of further weakness towards the next support level around closer to about 515. Or then it might trade sideways afterwards. Okay, the next question is on BRC Asia. Okay, for BRC, I think overall price still climbing gradually along this upward support line since the breakout of this 230 resistance level over here. So I think as long as it holds along this support, is should be still okay for price to try to retest this 244 previous swing high resistance. For Delphi, I think overall it's still quite range bound. Price actually, since breaking above this range resistance 83 cents, which was a prior breakdown, went back to retest the old higher range resistance at 87 cents, can find a bit of resistance. So I think I still think it's quite sideways between 83 cents to 87 cents for the time being. And then for Aztec, I think some consolidate is doing a bit of a consolidation at this $1.02 resistance. As long as it continue to form a higher low above this $1 support, I think it's still quite positive for price. Price could actually, if it breaks above the recent resistance $1.04, it could trend higher towards the next level of resistance at around $1.06, which was the previous swing high back in May 2021, and followed by about $1.10 next. The next question on Singtel. Singtel, I think it's currently a bit of a sideways consolidation. This prior support, so prior resistance around 310 turn support. You can see the few lower wicks over here. So I will expect price to get hold this as a bit of support for the time being. Resistance to still be around 320 over here, which was a recent breakdown level. So still some sideways consolidation for now. Okay, then for Semco Industries, I think overall just quite some sideways at resistance. But overall, price is still holding support at around 545 previous resistance. So still positive overall. If price is able to get above this 570, then we are likely to see higher highs. Yeah, 570 was the previous double top resistance. The next question is on Franken. Franken is a bit of weakness again. Price tried to break above this 133 level, did a retest, however, couldn't hold support, and then pulled back. So I don't think maybe price could actually retest this 125 level over here, which was a previous resistance. Then it might trade a bit of sideways between 125 to 133 for now. And then for iFast, I think some strength recently, breaking above this quite a strong resistance around 765, and then actually hit about this next level of resistance $8. So some slight pullback currently. But if price is able to hold this 765 to 770 area as a support, I think it could still go higher, given that it's currently in this this stretch where it's a bit of a bullish stretch where it broke few resistance levels. Then above $8, the next key resistance level will be closer to $8.30. Next question is on Apple. So for Apple, I think there's still quite a lot of resistance around 660, this area over here. Price try to break above, but however, it just failed to hold the 660 attempted breakout. So it came back down a bit. I'll expect price to hold a bit of a support this 648 level over here. It might do a bit of sideways between 648 to 660 for now. But if it fails to hold this 646 level, you might see price come down slightly lower towards the next support level around 635 for Capital. And then for the Lion OCBC HST, quite similar to the Hang Seng for now. Some pullback, but I'll expect some range consolidation. Support is likely to be around 73 cents, 74 cents this area. Over here, there's some short-term resistance around 80 cents. So I would expect some consolidation for now. Okay, for Fraser's Hospitality Trust, I think overall should be quite range bound for the time being. Still finding some resistance around 46 cents, 47 cents area, which was prior support level breakdown. But for now, price should be holding above this 44 cents resistance breakout. So over here, I will expect some sideways to take place for now, between about 44 cents to 46 cents. And then for Far East Hospitality Trust, I think overall it's slowly trending upwards, but maybe some resistance from this channel from the top of this, near the top of this channel around 66 cents recently. So it's a bit of a pullback, holding the prior horizontal resistance as support at 63 cents. So I will still expect some sideways consolidation for now between 63 to 66 cents area. And next question on Mapletree Logistics Trust. So for this, so finding some resistance at this 150 level. Price couldn't hold this 145, 146 breakout level as well. So go back a bit lower to actually do retest of the range support around 141. So over here, I would expect some support to hold to actually do just consolidate in the range. Below 141, next support level is around 137, 138 as well. So I will expect some sideways consolidation for the time being. Yeah, then for some tech REIT, some pullback from resistance as well. 130, 134, yeah. Resistance just it went sideways over there, and then we're seeing a bit of pullback. But support should come in over here around 125, 126. Previous resistance over here, some consolidation that go as support. So maybe some bounce for now. Then short-term resistance will be this 130 level over here. And below 125, next support level will be at around 122 for Suntech REIT. And then there's a question from Maybank. Yeah, maybe I think overall it's a bit of a sideways currently. Yeah, price just consolidating to around 1040 to about 1070. Yeah, so I think for now this will likely still continue for a while for Maybank. Okay, the next one is on this JKU ETF SSE 50 China. Okay, I think for this we're seeing a bit of a pullback recently. So yeah, a bit of weakness currently because this previous breakout level around 245, 246 has acted as a resistance over here for now. So I think price should come down a bit lower to actually retest this 235 level, next level of support. Then if it can't hold, next level of support will be closer to about 225 over here. So I'll expect some slight pullback over here for this counter. Okay, then for next question is for yen lot. I think yen lot quite sideways for now. For now, is holding just trading sideways at this support level around 71 cents. Resistance is about this 76 cents to 78.5 cents area. So I would still expect the price to actually just sideways within this area for the time being. And below 71 cents, next support level could be around 65 cents area. Okay, next one is digital core REIT. For this, I think still rather sideways. Price is still holding around the 63 cents as resistance. But positive thing is that we have seen higher lows actually form along the way. Higher lows form along the way. So as long as the price can maintain this, I think could be an ascending triangle. So for now, maybe some support over here at 58.5 cents for this DG core REIT. I think I'll take one more. Next one is 2800, this tracker fund Hong Kong. Similarly, a bit of a pullback recently. Currently, we're testing the first support level around here, which is around $21. So a bit of a bounce, but I will expect some near-term resistance to come in at this $22 to about $23 area over here. So probably this price will do a bit of a sideways currently. Yeah, I think I'll just apologies, I can't take all the TA questions, but feel free to post inside our P3 TA community group, and I'll take it from there. Now I'll just send back a time while I rest my clicks for the other questions. Thanks.
Yeah, okay. Let me just do a very quick wrap up. New IPO food innovators, good to subscribe. I didn't find it interesting anyway. So for food innovators, they are a company from Japan. So, but most of the business is they actually release 214 properties. I know it's very unusual. So basically what they do is they have a master lease with some landlords, and then they will take this master lease and release it to restaurants in Japan. I'm not sure how this model works, but that's most of the business. And then they have probably co-operate 10 restaurants in Singapore. So you couldn't really consider them like a food operator or restaurant operator. They are part landlord and part food operator. I'm not sure which is the better part, but that's the impression I got. Yeah, I didn't find it interesting. Yeah, but I guess at least we have two IPOs this year for Singapore. If there's any consolation. Does venture do stuff for AI? They didn't explicitly mention. So I doubt they actually do anything. They don't do, the big one is the server AI. So don't see them doing it they never explicitly mentioned. I think the closest they said was they are doing optical fiber at data centers, but nothing specific for AI. Yeah. If not, I think the revenue would have just spiked up if they did any AI servers. Any update for Yoma's share price? And really nothing as well. Yeah, I don't have any updates for What's going on with Dynamax? Share price surge last Friday. Do you see Hanwha raising? The share price is suspended. I don't rule out the possibility. I think they want to keep it listed. So my guess, maybe they raise it. They probably didn't say the offer is final. So once they say offer final, that's when you can rule out any increase. So they probably left the window open when they did the 60. So just to give some numbers, the market cap about 600 plus now. They have about 300 million net cash. If you strip that out, the market cap is probably 400 plus. Then they make like 70 million you analyze. So they're trading at probably 5-6 times PE, excluding cash. So there could be room for Hanwha to raise the thing. But just a reminder, Hanwha wants to keep it listed, and theirs is a conditional. So they just want to have like 50, at least 50% control. They just want to have control over the company, and they want to keep it listed. So I don't rule out that most likely they probably raise the offer. My limited guess. Does Yang financial benefits from the recent China stimulus measures? Yeah, it should benefit them. I think like Myanmar mentioned before, I think their NPL ratio for their money lending business in China is 40%. So any improvement in the economy should benefit them. Yeah. But if you want to go into China financials, I think I'd rather buy a Chinese bank. Yeah. Why has China's share prices of BRC Asia and Baoste grown in the last few weeks? No. There were no specific reasons. Sorry, CK. Didn't really hear anything. I know the industry, just the whole I didn't hear of any particular thing. We did try to approach Baoste for webinar, but the email bounced off. But we'll try again. Last question. Rich Chinese are buying up Malaysian properties. I don't think so. No, speaking to some, the macro factor seems to point to a Malaysian property and currency boom. Any comments? The local Malaysian property market still supported by domestic. I don't see, like, if they buy will be KLCC. Not that I heard of, of KLCC property prices are suddenly picking up very sharply. Thanks. So thanks everyone. Yeah, sorry, some of those questions I can't really answer it. We don't have the full information to help answer it. Yeah. So with that, I'd like to thank everyone. And thanks everyone for attending. Thanks for your questions, and we will try to get the webinars sorted out for those that were requested. Yeah. Thanks everyone. Have a good week ahead, and thank you for all your questions and your time.